Hi everyone, welcome to the investing webinar. Which stock should we be holding for the next 12 months? Let me know you can see and hear me. Put it into the chat box so I know you can hear me loud and clear. We're going to start. Now I'm doing something unusual with this webinar, something I've not done before. I'm really targeting it and creating it for my own family, for my aunt, my uncles, my sister-in-law, my sister. And the reason is they've all been asking me, what should we do for next year? In fact, my brother-in-law asked me, I want to save some money for his children, my nephews and nieces, school fees. What should I do? What should I invest in? So I thought, you know what, why don't I just target it sort of towards them, because that's actually going to be relevant for everyone. And you might think, Alpesh, given they're in your family, shouldn't they already be experts? You know, you'd think, wouldn't you? It just goes to show most people don't have the time, the energy, or the effort to do it. So I'm going to really simplify. I'm going to make sure in the next 60 minutes you become experts in investing, because I want your money to work hard for you. So let's start sharing the slides straight away. Let me know where you're from as well. Kevin, Susanna, Guy, Barry, everyone, great, you can see and hear me, so that's fantastic. And like I said, let me know which parts of the world or the UK you are from. So like I said, top market insights for 2021. And we're going to look at global stocks, which is why there's pictures of me out in Korea last year, where I was giving a talk on what, you know, on investing and the markets and so on as well. Hi, Thea. Hi, Derek from Chesham. Vishnu as well. Vishnu, I think from Leicester, if I'm not mistaken. Michael Worthing, Sussex. PJ from Ireland. Some familiar names and faces. Fantastic to have you all on board. So like I said, geared it towards my own family. So I'm keeping it really something which basically better be fail-safe, because, you know, I'm answerable to my family, and also making it straightforward and simple for everyone, no matter how big your portfolio is, whether you're just starting off with £1,000 and thinking, what the hell do I do? I just want to get along the way, or whether you've got 10 million on this webinar. Okay, so it's going to be relevant for everyone. Now, for me, 2021, I'm hoping to get this book out eventually. So one thing I'm really rubbish at forecasting is when I'm going to get my books finished. So the Financial Times are due to publish this next year. That's going to be 2021 sort of exciting thing for me. So why are people excited? Well, one of the reasons people are on this webinar is you're probably seeing things like this, 52-week highs in companies like Tesla and PayPal and Nike and AbbVie and Costco, and you're thinking, hey, where's my share of the pie? You know, you pick up the newspapers and you think, well, wait a minute, is it too late to get into some of these names I hear about? And in any event, are they too risky even if I do get in as well? Okay. Amos asked, will there be some relation to Indian stocks? Not really, unless they're listed on the New York Stock Exchange. So something like Tata Motors, Infosys, only if they're listed on the New York Stock Exchange, which some Indian companies are, but it won't directly be related to that, because money's money. I'm sort of, the way I joke about it, and forgive me for saying it this way, I'm not racist when it comes to stock picking. I don't care whether the company is American or British or Indian or like me or whatever else. Okay. So we all want a slice of our pie. That's why you're all here. How might 2021 look? Well, this is the S&P 500, which is just a broad measure of the American markets. We'll come to the British and global markets in a second, and how, for instance, India, China, the United Kingdom, United States, and Europe are forecast to perform next year. But before we do that, let's just look at this. Look at this. And what you can see over there, I should actually make my fat face a bit smaller. I think I should make my thumbnail a bit smaller over there, and probably shove it over there, I guess. Oh, God, there's no space for me anyway. There we go. And you can see there are some years in which it does rather well. Now, look, let's be absolutely clear. Let me just explain something to you. Any given year in which the market itself generates about a 40% return makes my life a lot easier, because that's my targeted annual return for my global stocks. Okay, for UK stocks it's only 20% because they grow less, but for global 40%. All right, now if next year the market only grows, say, 20%, then my job's going to be a bit bloody harder to try and beat the overall market. What I'm saying is, in a rising tide, all boats rise. My job's a lot easier if the market has a really great year. What's it going to look like next year? Well, as you're going to see in the course of this webinar, it's supposed to be quite bullish, but there are some worries as well. So we're going to pick individual stocks which, should the markets decline, will not fall as far, and should the markets rise, will zoom ahead and outperform the market. That's the simple criteria. Markets, if they fall, and I'm not forecasting whether they're going to fall or rise, I think there's a 70% chance they'll rise, 30% they'll fall. In the 70% outcome they rise, I want my stocks to outperform the market, and in the 30% that they fall, I don't want them to fall as far. Right? It's as simple as that. So that's what we're looking at, and you can see where I'm getting my figures for the kinds of returns I'm targeting. The reasons I'm targeting 40, whoops, let me just go back a bit. Go back, Alpesh, you got overexcited then. Go back, boy. There you go. Right. The reason I'm targeting 40% is because very often the market does indeed just generate that by itself. And given that it can generate even 30% many years, I want to try and outperform that. What are we going to do in these rubbish years when it declines? Well, we're going to make sure that we can still at least outperform it and generate a positive return. How the hell are we going to do all of this? That's a lot of big promises you're making there, Alpesh. A lot of big talk. How are you going to do it? That's what this webinar is about. That's the results I've got to generate from my uncles, aunts, and everyone else in this webinar. So, getting on with it. There's a problem though. There's so many complicated factors. When I talk to family members and say, you know, and they say to me, well, what kind of stock should I look at? Of course, they all fall into the trap of, oh, I'll just give it to an expert, or I'll just put it in a fund, which I show them are the two of the worst things they can do in terms of returns. And I prove it to them, and I'll prove it to you in this webinar. And the reason they do that is because, you know, if I start talking to them about valuation and price, share price relative to profits, which is what P ratio is, or share price and profit growth, which is what PEG is, or share price and the assets of a company, of course, they're going to zone out. Most of you are going to zone out and say to me, oh, great, thanks, Alpesh. I'll leave the webinar now. I'm just going to give my money to a broker and a fund manager, which is what the brokers and fund managers want you to do. They want you to give it to them so they earn the fat fees. Instead, what I'm going to say to you is, please just spend 60 minutes with me so I can teach you that this isn't as difficult as you might have thought, and in 60 minutes, turn you into your own fund manager, your own broker, and an expert. Right? It's a big statement. Well, the way I'm also going to guarantee it, and I'm going to guarantee it, is this. I'm going to give you a free copy to download of my book, Investing Unplugged, a free copy. So if you think I haven't given you enough in this webinar, you'll get a free copy of this international bestseller with lots and lots of wonderful reviews it's received. Right? So that's really going to sweeten the deal for you to watch this webinar. And the reason is I have a mission, just for my family, to make sure people are making the most out of their money. So what about growth then? That gets complicated because all of a sudden, we know undervalued companies are better than overvalued ones. We know high growth companies are better than low growth companies. I mean, even an idiot could tell you that. But how are we going to measure all these things? Is it sales growth, Alpesh, cash flow growth, earnings growth? You can see why people zone out. And it's my job to explain to you, when I mention a stock name, that this is the basis on which I've picked it. So you go, yeah, I'm not trusting Alpesh, but I'm trusting the rationale, the reasoning, the analysis he's done. We know companies which generate income are better than companies which don't, as a general rule. Of course, there's exceptions. You could get some really overvalued company with no growth prospect, no income, but suddenly a speculator pumps it up. Well, we're not going to chase for those gambling stocks. We're going to play it a bit safer to get our 40%. Okay, so we're going to look for companies which generate some income for us, right? Well, they can't generate income unless they've got profits and dividends. Oh, it gets a bit complicated. Don't worry. The way we're going to do it, which is so different to what fund managers want you to do, is this. We're not just going to look at value stocks or just growth stocks or just income stocks. We're going to look at value, growth, income stocks, which have got momentum. In other words, which are performing well, which are showing a good trend. Right? And again, there's so many complicated things to look at. We're not going to look at all of the, well, I'm not going to teach you in this webinar how to look at all of these. I'm going to do it for you and explain to you the philosophy that I want you to remember these letters. VGIM, value, growth, income, momentum. Well, there's also statistics, right? And I'm going to explain to you why I filter through all of these things. I want the kind of stocks which are pushed by Goldman Sachs, owned by hedge fund managers, undervalued, high growth, strong income, strong cash flow, good upward trend, and statistically outperform the market. Now you're saying, well, Alpesh, you're asking for the bloody moon on a stick. I am. I analyzed 9,000 stocks, and I'm going to show you 9,000 stocks we analyzed, and then narrow it down to 50, and you pick them. But by the way, just to make absolutely clear on this webinar, I'm not managing your money. You're managing your own capital. You're going to open your own brokerage account, manage your own money. Many of you are already doing it. You've got SIPs and pensions and ISAs. You're going to be doing it yourself. This is not me saying, oh, please put it into my fund or please give it to my brokerage. I don't have a brokerage. I don't have a retail fund. So you're going to be doing it yourself. That's the mission. That's why fund managers like me, hedge fund managers like me, write books like this so you learn how to do it yourself, please. And that's the same with my family. They have to do it themselves. They ask me all the time, will you do it for us? I say, no, I'm not bloody doing it for you. Why should I? It's a pain in the ass doing it for somebody else, okay? Now, one of the things we're going to have to be mindful of is this problem of bubbles. Wait a minute. The occurrence of the word bubble in news articles is at the highest it's been in 2 years. People are worried about it. It could become a self-fulfilling prophecy. So we better have stocks which protect us as much as a stock can, right? They're not a bank account. They're not going to protect you 100% from your money going down, but as much as a stock can. So I'm mindful of that. I don't want you to think we're just sort of euphoric. I'm mindful that people are concerned about this issue, okay? He says, moving around the screen. Now, I want to show you something. This is the 1 month performance of global stocks. And my friend Amar, let me know which part you're from. I assume you're in India. Most of you are from the UK, obviously. And you can see here Indian stocks, okay? HDFC, Bank, Infi is Infosys as well. These are all global companies. Every single one of these is a global company, all right? What I mean by that is it's actually listed in the United States. And just like UK stocks I'm going to talk about, these US stocks you can buy through your broker, put it into your SIP or ISA. People don't realize that. You can actually have Indian companies in your SIP and ISA and they go, what? Yeah, in your tax-free savings plan, or not if you don't want to put them in those. My point is, that's going to be one part of the universe we choose from. Why do I want to choose global equities? Well, because I want a big number of interview candidates, okay, before I select. And this is the 1 month performance. I want to keep an eye on this. And I want to say to myself, well, what the hell's happening in Argentina there? Is that worth me looking at? Maybe it's not. Maybe I just want to have domestic American and British companies. But the point is, the reason I look at global is because I'm interviewing candidates to put into my portfolio, and I want CVs of companies from around the world. So what am I looking for in that CV? Think of it like you're an employer, because you are. When you're investing, you are an employer of the companies that you're buying shares in. So you're going to decide whether or not to employ Apple or Infosys or AstraZeneca, or for God's sake, Rio Tinto, HSBC, whatever. You can see a whole bunch of British ones over there. That's going to be in our universe. Just so you understand where my universe is. These are just purely the American companies in the past 1 month. I'm just setting the scene for you, okay? So this is going to be in our universe. Now, I'm not going to buy into all of these like a nutter, right? But I know, and some of you have been following me since April, March, when I started doing the longer term investing ones, through following me, Jay, on my various channels, and I'll show you those because I have to update this. My team has to update this. So Disney, you'll know, my sister had asked me for a children's school fees again, and which ones were relatively safe. And I said Disney, and now it's up 20% in the last month alone. Or there's Netflix and etc. But that's just 1 month. Are we going to be trading month to month? No, we're going to hold. And the numbers I want you to remember are 12, 15, 25, and 40. 40% is our target per annum. 15 stocks for 12 months. Okay, and the number 25 I'll explain in a second. You can write all those numbers down. I'll reiterate them later. So how do we pick them? How do we pick them? How do we know when to sell? Those two simple problems. There's only two problems: when to buy, when to sell. I'll explain that so that you know, you learn the skills on how to do it. Now, one of the other things I really want to give you in this webinar, and it's critically important, is this. I just want to highlight something to you. See that? This kind of stuff really annoys me. UBS, rich clients get Goldman, PIMCO strategies with no extra fees. Now, the reason that stuff pisses me off is because, guess what? My family, for whom I'm doing this webinar basically and inviting everybody else to watch it, they don't get access to that. I mean, they do thanks to me, and you will thanks to me. But my point is, the mass public don't. So there's this group of fat rich people who've got £10 million minimum accounts that it costs to open a private client account at UBS or Goldman's, who get access to this information and they share it amongst themselves. You don't get it. And guess what? There's no reason why you shouldn't have it. Because if at the end of it says buy, I don't know, Square or PayPal, well, maybe you'll buy £1,000 worth of those shares. So what? The reason they don't give it to you is because you're not rich enough to pay them their fees. They're greedy. I think that is a closed shop. I don't think that's fair. So I'm going to share with you some of the strategies and what these investment funds are doing. And the reason I can share that is because as a hedge fund manager, I get that information across my desk so I can share it with people. And it makes me feel good. as well, but also it makes my webinars far more interesting for the audience than if I didn't give you that information. So I'm going to share some stuff like the kind of stuff I get from JP Morgan. Okay, so that's JP Morgan stuff and what they're telling their richest clients. Right, so I'm going to share some of those insights with you in this because I think it's unfair that you don't otherwise get them. Right, it's as simple as that. If nothing else, you're going to learn a hell of a lot about what really happens in the world of investing. Now, in case you're wondering who the hell I am, I've been doing this since 1999 publicly, and that's me in 99 on my show Making Money with Sally, and that's me in 2019, which is the last time I was inside the studio as opposed to remotely, also with Sally, now at the BBC, okay, doing my broadcast. So I've been doing this for 21 years on television, and the reason I keep getting asked back is because I'm pretty bloody accurate at it. Okay, I don't mean to sound arrogant, but I think if you're good at something, you should blow your own trumpet about it. Let's get back to you guys. Okay, so one of the important reasons it's very clear we ought to look at the markets globally is this. Look at this chart, okay, and it's this year. And you can see up here in purple, up 46% happens to be the NASDAQ. Just happens to be. Could have been something else. Up here is the more what's called the Russell 2000, which is the smaller companies. Okay, 2,000 small companies, up 20%. Down here is the UK markets, down 10%. Now that might be an aberration for this year. Next year it might rocket up. That's not my point. My point is, if I don't look at global stocks, then the difference in performance is about 55% between the best and the worst, and that's just an index. An index is just a collection of stocks. You should be able to do better than a basket of stocks because you want to cherry pick the best ones. But let's say you did no better than an index. There's a 50% gap between Britain and other parts. Now, next year, hopefully, that'll be inverted. My point is, we need to look at a larger number of stocks. Now, logic alone dictates that. If you interview a very narrow candidate group, and sadly, most people invest in their domestic markets alone. So if you're in India, you only invest in Indian companies. If you're in Britain, only British ones, and so on and so forth. The danger with that is you're not going to be able to cherry pick the best of the best. The 15 best you need to hold for 12 months. Like I said, 12, 15, 40, 25 of the numbers. And write that down on a piece of paper, and please make sure you've got a piece of paper. Make sure also nobody else is using the internet and you've turned the TV off so you can focus on this. Treat this like a one-to-one university lecture from the best lecturer you've ever had, because he's the only lecturer who's determined to make you money, all right? So now we know we need to look at those global ones. I've made the case for that. By the way, I have no conflict of interest with you. I'm not trying to get you to buy a book because I'm going to give you it for free. Okay, and I've written 18 of them. You can see them over my shoulder, published by the FT. I'm not trying to get you to buy them. I get £1 in royalties, and you're going to download it for free at the end of this webinar. My funds are institutional. So unless you are a sovereign wealth fund watching this, or a pension fund like AXA, Aegon, or an ultra high net worth like some of our investors, sorry, they're not open to you by law. I'd be committing a criminal offense if I were to market our funds to retail clients. So that's not for you. I'm not a broker. So not interested. I'm not a long-only retail client fund manager. So got nothing to sell you. No conflict of interest with you on this at all, other than to make sure you're well informed on what we do. The one thing I do want you to do, because fund management is the most useless profession in the world, making money from somebody else's labor is the worst way of really making money, I'm afraid, morally, because I buy shares in somebody else's company, they make money, then give it to me for sitting on my fat ass, okay? It's not fair. So find something useful to do with the profits you're going to make. Now, this has really drilled home with some of the people who've listened to my webinars and have been on them. I happen to be co-chairman of the Lombard Trust, which helps widows and orphans. You don't have to pick this. You can pick any good cause you want. But when you make money from the stuff I'm educating you with, please think about giving something to a good cause, preferably mine, but you can pick others. Okay, Lord Lombard is in the House of Lords. He's the one who founded it. And like I said, it helps widows and orphans. Curran and I, Lord Billamoria and I are co-chairs. Lord Billamoria is president of the CBI as well, the Confederation of British Industry. I think you'll have heard of Mira Seal, of course, and a few others on there, I am sure. Okay, one important piece of information. This is not specific individual investment advice, because I don't know you guys individually, okay? So it won't be individual investment advice, right? Now, 2021, Hope is not going to be a strategy. We are not simply, thank you, Alex, my friend. We are not simply going to be hoping our pensions will turn around and poor performance will go. I'm going to explain to you in this webinar why your pension is underperforming, why your financial advisor is underperforming. I'm going to actually x-ray your portfolio because I know what it looks like and why it's underperforming. Or if you're picking your SIP yourself, why you're getting it wrong. Okay. And I'm going to appeal to your logic and sense, and you're going to go, oh yeah, I see why. And like I said, I'm not just making this up in 2020. I'm telling you this since 1999. And I've been telling you to the extent that the Financial Times said, hey, what you're saying makes a lot of sense. How about we publish each week what you're writing, what you're investing in? Diary of an Internet Trader. So that was from 1999, okay? 21 years been doing this. And you've seen me recently on the BBC talking about HSBC's results and so on and so forth. So that's a bloody good track record, okay? And the reason I'm pointing this out is I really want you to listen to me. That's why. So let's start off with our goal. Assume you plan to invest over 10 years. Now, I do this in all my webinars, but it's really important to have not hope as a strategy, but an actual specific strategy. When you've got SMART goals, in other words, specific, measurable goals, okay, right? That makes a big difference. So let's say you assume to plan, plan to invest over 10 years. And this is what I say to my family as well. So I'm giving you the same advice I give my loved ones, right? So for the sake of this webinar, you are my loved ones, people, okay? Now, thank you very much. Thank you, Ravi, my friend. And you, with my help, let's say you make 20% per annum. We're keeping it modest. You saw the market deliver some of that anyway. In actual fact, with my global stocks, I want 40%, but I'm not going to try and stress you out with that. Let's just say 20%. Some years more, some years you make less. Nothing extravagant, nothing pessimistic. And it's not me making it for you. It's the market. It's the stocks. You know, when you look at some of the stocks and the crazy returns they do generate, and we're talking big name companies everyone's heard of, then you think to yourself, yeah, it's not too bad. When you think even Apple's up 50% this year, you think, well, yeah, okay, maybe this is not pie in the sky. Okay, so 20% per annum. Let's say you've got 100,000 in your 401k, SIP, or ISA, or any other investment account, right? And let's say you plan to add 1,500 each month. Now, many of you, these are ridiculously large numbers, right? In which case, divide everything by 10 if you wish. Divide everything by 10 that I'm about to tell you. Okay, you plan to add 1,500 each month. You will have £1 million after 10 years. It's as simple as that. You'll have £1 million after 10 years. You need this plan. If you don't have a plan, you're not going to start. If you don't start, you're going to miss out. And then you're going to look back in 10 years and think, I wish I started 10 years ago when I heard that webinar from Alpesh. This is what it looks like visually, right? The red line is where you end up. So you go from 100 to $1 million. My job for my family, the ones who are listening to this webinar as well, because I told them, listen to this one because they're always asking me what should we invest in. My job is to convert every 100,000 into $1 million over 10 years. Actually, it's to do it sooner, but that's my sort of worst case scenario. Okay. And the green line there is just shows you how much contributions you've made. Now, that's not for everyone because that's too much capital to start off with and add each month. So let's start off with something modest. Many of you here will be students or young people or living in London, so not with much spare cash. Okay, you might be in your 20s, you might be in your 30s, as opposed to people in 40s, 50s, 60s who are on this webinar as well. So the less well-heeled of you, let's assume you've only got 10K to start with. All right. And you plan to add 6K a year. Now, this is closer to my sister-in-law, right? She's a school teacher, and she's got closer to 10,000 to start with, and she can possibly muster 6K a year. Probably not even that, all right, which is 500 a month. Probably not even that. Probably just about if she doesn't get a Costa coffee, right? Then this is what your returns look like. And I said to her, and she said to me, you know what? I get up at 6 in the morning. I deal with special needs kids, and my money isn't, I don't know what to do with my savings, and I've got very little savings, she said. So I said, look, I'm going to create this webinar for you. I don't know why it didn't occur to me sooner. I'm stupid, that's why. Right? This is what it looks like for her. This is what it'll look like from year 0, where she starts off with 10,000. After 15 years, she should end up with 600,000. That's not me doing any magical formula. That's just because if we get those returns, 20% per annum, now you might say, well, 20% is over optimistic, Alpesh. Fine. We'll reduce it then if you wish. Don't forget the market itself generates some of that anyway for us. But this is the reason why I say I want people to start. At least please start, okay, investing. And in her case, or in the case of my son is like this. He was born 2 years ago, and he's down here. He's in year 2. okay, because we opened a junior ISA for him. So he's got about 15,000 in his account. So he's about over here, and he's been generating the 40% per annum. So he's actually doing a bit better than this, right? But he's on track that by the time he goes to university, the lucky little bugger will have over $500,000. So my biggest problem will be how to make sure he's not spoiled, right? Which is a nice problem to have. My point is, it's really important to start early. So we need to know, how do we do this? And in case, again, you're thinking, well, Alpesh, that's all well and good. And yes, the market does some of it. But how do we know you're going to teach us anything which is going to deliver the other half of it? What record do you have of that? Well, other than the fact, the media stuff. This is what's been independently verified since I've been doing this publicly since 2004, publicly verified. Okay, by a Financial Times award-winning company, completely independent of me. They've been looking at my picks every single year, every January. I give them my 12-month pick since 2004, and every year they've been doing it. I've got to update this because actually it's even better up to 2020. This was, I took the chart up to 2016, or rather I took their chart up to 2016 of the results they've got of me. And so, like I said, look, the curve doesn't go upwards. Some years the markets are crap and I can't help it. Right, that was probably 2008, right? So you get a little dip, but overall you get the idea. In real world, this is what it looks like. The idealized world, of course, it's like this, but actually in the real world, it'll go like this. And do you know what the beauty of all this is? That's not me managing it for you or in my account or with my fund or nothing like that. It's in your brokerage account, whichever broker you use, you doing it. It's yours. So you can wake up at 3 in the morning and go, yeah, okay, I'm happy with that. You're not waiting for a fund manager report or anything. You're in charge. And just so you want to know, okay, well, what are you talking about? Give us some specifics. This is my son's junior ISA. He was born in 2018. Okay, it was 4K in the first year. The max you could put in, it was 9 the second year. These are some of his returns, right? Up 48%. And that was back in up to about April. And since then, obviously, the markets have gone even more higher in all of these stocks, right? So we'll come back to what I earn and what he earns in a second. Let's just break this down into overcoming some of the problems of investing and then some of the solutions and some of the stocks that I like. Okay. So here we go. Here we go. Underperformance is rife amongst active fund managers. One more reason I don't want you to just give your money to a fund manager. There are certain things a human can learn to do themselves in a very short space of time. Brain surgery isn't one of them. Rocket science isn't one of them. Managing a portfolio is one of them. Driving a car is one of them. All right? Okay. That's why. That's the point I'm making to you. There are certain activities in human endeavor you can learn, anybody can learn, and I can teach them. And I can teach anybody to invest, just as a school teacher can teach anybody to write, and a driving instructor can pretty much teach everyone, other than my mum, how to drive. All right? Simple as that. Now, I've mentioned it before, I'm going to say it again. There is a poverty gap. And the reason I mention this is because it's a poverty gap that you're suffering from. And the reason you're suffering is not because you've not invested. It's because even when you've invested, and this is why you're scared of it and you call it gambling, is because even when you have, after, this is over the last 5 years, in red is the UK market, by the way. Now, God willing, next year it will do incredibly well. But I'm just saying, over the last 5 years, you're down 12%, whereas your American cousins are up 128 bloody percent. Now, that's not fair. Because after 5 years, just by tracking an index, not even picking a stock, just doing an index tracker, right? They've more than doubled their money and you've lost 12%. No wonder British people are saying, stock market, gambling, I don't even want to go near it, only for idiots and fools and gamblers. And the Americans are saying, stock market, let's put some more money in. And guess what? Self-fulfilling prophecy, it's at all-time bloody highs. So they keep getting richer and we don't. Right? So my job is to turn that around. So those of you watching this, don't get left out of the market, and you don't put your money in the 95% of stuff which is too risky anyway. You put it in the 5%, which is a lot safer and gets the kind of returns we want to get. Right? That's my job. In other words, my mission is to make sure your money works harder for you. And I'll give you an example. A typical portfolio I get handed down by someone. Don't take a picture of this thinking it's mine. It's not mine. It's one of my apprentices, one of my students. Okay, I better do the pen on this. Okay, so you can understand that it's not what I'm saying you should do. Okay. This was one of the ones he gave me, and I said, "Why the hell did you pick these?" And he didn't know what some of these terms mean, so I taught him what these terms mean. I said, "Then that's a measure of volatility." compared to the returns you're getting, and they're all red. And so why'd you pick these? None of these are giving you a decent return. And indeed, over the 3 months when we looked at it, he was down significantly, pretty much everything. By the way, during the same 6 months, I showed him my portfolio, which was up significantly, and he was down about 40% in most. And he said, the markets are down, what can you do? And he said, well, but it's okay, Alpesh. Look, I've got names which everyone's heard of, like Aviva and BAE Systems. I said, you're right, there are names people have heard of, and you've used that as a kind of safety blanket to think it's okay to lose money. It is not okay to lose money just because you lost money with buying Lloyd shares or BAE System shares or Aviva shares. Just because the names are of companies you've heard of and they're big names, it is not okay to lose money. Listen to that again. It is not okay to lose money, right? I don't plan on being a loser. So I said to him, this is rubbish. You're making all the mistakes, the mistakes that so many students who come to me make. One, they only pick companies from one country. Two, they pick by name recognition. Three, they have no idea that they're losing money, and so they hold on too long. And also going four, they buy things which are far more volatile and risky. Worse still, then you've got category two. You've got the second type of investor. They give it to an independent financial advisor or a fund manager, and this is what happens now. In case you guys don't know, if any of you got funds, put your hands up if you've got funds. Put your hands up if you've got funds, okay? If you've got funds, this is a typical fund, which one of my students had. UK listed growth fund. So you'd think, oh, growth, wow, what a sexy word. And it had all these diamonds there, and number 8 out of 10, and they say that's the marketing gimmicks that the fund management industry use. I hate the fund management industry because they'll do this, okay. And Narendra, I know, it's so many people. Look at this, after 3 years, it's down 2%. You might say, yeah, but Alpesh, the market's to COVID, blah, 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 blah. Yeah, well, the US stock market's at all-time highs. Some of those massive companies like Apple have gone up 100% since March alone. So what's your excuse? What, you've not heard of them, or you've not heard of America, or you didn't know you could buy those from the same brokers you can in the UK and put it into your SIP and ISA? What is your excuse? No, because it's too complicated. It's too complicated. Okay, but look at this, right? Look at this, down 2%. Why? Because this useless fund manager, for a start, this is what he's doing. And this is typical of all funds. Whatever fund you've got, ask to see the documents. Investment, £10,000. This is the fund's documents. If you cash in after 5 years, recommended holding period, they always recommend 5 years. You know why? Because the chances after 5 years you'll actually bother doing anything, and they get guaranteed income as a result of you being in for 5 years. These are the fees, £1,000 out of your 10,000. They're going to take 10% after 5 years. After 5 years, they're barely going to generate any return anyway, and what they do is going to go into fees. Their job is to make sure they generate just enough they can take their own fees out, and you look at it and go, oh, well, at least, what can I do? 5 years have gone. Well, I'm stuck now, aren't I? 5 flipping years. We're going to review things every 12 months. Every 12 months, we're going to review our stocks, okay? I'm going to give you a very simple buy strategy, a very simple sell strategy, and it's not going to take you much time at all to do it, okay? I'm going to give you all my knowledge, not just from JP Morgan, Goldman's, what are they buying, what's in Warren Buffett's portfolio, but also from all my books. Don't buy them. This is not a plug for my books. Get a pound in bloody royalties from the Financial Times. Yeah, there's a reason Financial Times are so rich. My bloody books. But I'm giving all my data from there and from my 200 FT column. So in case you're wondering, well, how do we know we can trust it? It's been published already. Everything I'm telling you has already been published, and it's been published years ago right up till now. Okay? Okay, and so I'm also going to give you, just to filter to keep that safety element for you, from UBS, from Goldman Sachs as well. All right, and I always mention this, and also the latest stuff I've got from SARS and COVID from Goldman's. Right? Why did I not? And many of you followed me, you'll know. Why did I not in March completely get out of the markets? And you know I didn't. Why? Well, because documents like this told us that Goldman's are telling their clients to put more money into the markets. So I stayed in, and lo and behold, the markets went up. That's not because I'm a genius or anything. I'm not. It's just because I thought to myself, well, why would I get out if I've got the kind of companies which, if the markets did fall and Goldman's were wrong, the stocks won't fall too far. And if they're right and these buggers make it a self-fulfilling prophecy, well, they'll do even better. Okay, and of course I was well aware that there were a lot of beaten down companies. And of course, if a company had fallen 50%, we know that if it goes back from 50 to where it was, you get to double your money. And God forbid, if it's dropped 90%, and it goes from where it was back to from where it is to where it was, then you get to 10 times your money. Forget the 10 times your money. Let's not be greedy, okay? Let's not be silly. I'm just saying this is what maths looks like. So I knew there's going to be some opportunities if it's fallen. So how do we find them? So let me give you that. I'm going to start back to front. I'm going to start with how do you know when to sell first, and then how do you know what to buy second. So let's start with when to sell first, okay? Because that's the harder part. Getting in is easy, like anything. Okay, getting out is the hard part. When to sell? People ask me. I'm going to give you a really simple rule. Okay, bloody hell, Narendra, £30,000 in fees. I can save that for you. Watch this webinar, and I'll save you 30 grand in bloody fees. 30,000. No wonder financial advisors are so freaking rich, and I'm not a financial advisor. Okay, before people get mistaken. I'm somebody who's educating you to do it yourself. No financial advisor ever does that because they'd be putting themselves out of bloody business, right? When to sell, right? I'm going to give you a really simple rule. The reason I'm giving you a simple rule, I could give you a complicated rule, but the reason I'm giving you a simple one is simple rules get followed. If it doesn't get followed, you procrastinate, and another year goes by, you get older, and you're not any richer, right? 12 months, and then you're going to reevaluate. So 12 months, holding period. Or if since you bought the stock, it drops 25% from the highest point since you bought it. Now, we can play around with that, can toy around with it. Ravi, you're on this. You've had some which have gone up 100%. And he said, what should I do, Alpesh? In your case, I said, well, you can either wait if it drops 25% and then sell, or I said you can sell the original capital amount and just let the profits ride. Because if it's doubled up, sell half, let the profit. That's all very complicated. Keep it simple. Keep it simple. Reevaluate after 12 months. Or if it drops 25% from the highest point, whichever happens first, whichever happens first. Why such a simple rule? Oh, but I want complicated rules. No, don't have complicated rules. Please keep it simple. I pray, I beg you, please keep it simple, because in all our experiments we've done, in all my books, and all the research which has been done by academics at various universities, the more complicated the rule, the more it is you're going to screw it up. Okay? We can argue the toss if you wish, you're going to screw it up. So let's do the part two, which is the more important bit, what to buy, how to know what to buy, how to do it. I generally have about 8 strategies. I've only put 6 on this screen because on the PowerPoint, I couldn't make it go up to 8. I'm not a PowerPoint expert, all right? So there's only 6, it says 6 there, but I'm going to go through, the ones that I've got. Anyway, investing strategy 1, right? Let's start off with this one. Guru buys, right? Now, remember the numbers I told you, 12, 15, 25, and 40. 12-month holding, 15 stocks. Why 15? I'm going to prove it to you why. You can have 20 if you wish, or 25, but 15 roughly, okay? And then if it drops 25% from the highest it's been, you're going to get out since you bought it. And 40 is the percentage return. So how are we going to get that 40% return? Now, we're not guaranteed it. Of course we're not. You're not stupid. You know I can't guarantee anything. You know the market can't guarantee anything. My point is that's what we're targeting, okay? And if we get half of that in 20, woohoo, we hit our targets that we're looking for anyway. So the guru buys. Now, one of the many things I'm going to look at, this, by the way, just because I show you this strategy doesn't mean I buy these stocks. The more stocks that appear in more of my strategies, the more likely I'm going to buy them. So if it appears just in strategy 1, which is guru picks, and this is the hedge fund ownership report, right? It's the job of my team to get this information from the SEC, the Securities and Exchange Commission, or whatever other sources they get it from. And these were the most popular hedge fund stocks. Now, that doesn't mean I'm going to buy them. Doesn't mean they're necessarily good, right? But it tells me that a whole bunch of money in the trillions has been plowing into these. Now, don't just go and buy these. Take a photo of the screen if you wish. More importantly, these ones were dropped. And I'm a bit disappointed some of these were dropped. I don't own Wix. I wish I'd got it a lot sooner, but I'm disappointed they dropped. Like, I quite like that company. Anyway, I don't own any of the ones which are dropped. Let me just go through the ones that I own in this, which I own T. Rowe Price. Solar wins. I bet they're regretting that one on there. Okay, that's the only one out of that list. Can you see why? Just because it's in the hedge fund ownership report doesn't mean I buy into it, because we need to do more than that. My point to you is, you think reading a newspaper article and getting a stock pick on a Sunday Times newspaper or Shares magazine is enough. It's not. It's not. It won't make you the money. Similarly, even this won't. But I need to make sure I'm seeing more and more names come up. Another thing I therefore look at is I look at the hedge funds which are performing the best, not just in aggregate, but the best. So recently, John Kim of Hedge Fund Night Owl has been delivering 51% per annum for the last 3 years. So I'm interested. What the hell's John Kim doing? What's he smoking? Okay, well, he's got these names. Doesn't mean I'm going to buy them, but I need to keep I want to see which names keep coming up. This is strategy one, the guru strategy. Okay, so I own Amazon, I happen to own Microsoft, I own MasterCard, I own Visa, that's all of those ones. Okay, now wait a minute, Alpesh, why don't you own some of the others? I'll show you why, because it didn't come up in enough of my other strategies. It's got to come up in not just one, but multiple strategies. And continuing with the guru story, what do the big gurus own? So let me zoom into this for you. Okay, these are some of the gurus I really like. Okay, Bill Ackman, billion-dollar hedge fund manager. His portfolio is $6 billion. Okay, in millions, it's 6,573 million. He only owns 10 stocks. Okay, Bill Gates, he's got 17 billion in his stock portfolio. Of course, he's got other ownerships of property, real estate. He owns 45% of the Four Seasons hotel chain, but that's not in his stock portfolio. Okay, so his stock portfolio, 23 stocks. This is all on the SEC. They have to file this by law. Luckily with America, nothing is confidential. Warren Buffett has 50 stocks. He's got 175 billion in his stock portfolio. We're not talking Berkshire Hathaway, we're talking about his stock portfolio. Okay, what are these stocks? Now, one of the reasons why I say you should only have 15 is because if these guys with their billions have only got 10, 23, or 19 stocks or 50, can you see why you don't need hundreds of stocks? It's going to hamper your performance, and these are their top 10 holdings. It doesn't mean you go and buy it. Do not, please, go off and just buy these just because you see it on the screen. If you want, you can give me ample time to take a photo if you wish. Okay, but those I need repeating in my other strategy. So this is just strategy one, and I'll tell you what's in my portfolio in a second. Okay, but this is just strategy one. Can you see how I'm narrowing down my interview candidate list of who's going to be handling my old age pension and which companies are going to be handling my son's inheritance? Do you see how I look at things? And how I narrow it down? This is how I want you to do it, and I'm going to teach you even more how to do it. Okay, so that was those. If you want more detail, I've given Buffett as an example because everybody knows who he is, but I could have picked other gurus you've not even heard of. It's not enough to know what they own. There has to be greater weight to when did they add to it? How large a position did they add? Okay, if they only bought a little bit, they might just be reinvesting dividends. Who cares if they bought it? So your average journalist will go, oh, Warren Buffett has just bought General Motors. Well, that's not actually a good pick because it doesn't appear in any other strategy. Okay, and he might have just got 1% because, I don't know, put a minuscule amount in. So that's not enough. It's not enough. And just because he's a guru doesn't mean we buy into it. Look at he might be underperforming. He might be getting it wrong. We want it in multiple lists. This is another great list that my team puts together for me. What this does is colors all the major US stocks, the biggest companies, and the darker the green, the more of those guru portfolios the companies appear in. Now, the one which was most popular, United Healthcare, I didn't know about it. I bought into it. It's been doing rather well. Amazon's in there. Okay, Fox, Viacom, I'm going to come to in a second because they appear in multiple strategies. So I knew, yeah, these are worth getting if they're in multiple strategies, right? There's two types of stocks, performance and quality. Most stocks are performance. In other words, if they perform, I'll get out of them. If they don't perform, I'll get out of them. There's only 5 companies which I think are quality, which are the core part of my portfolio. In other words, the safer part of my portfolio. And by the way, I divide those holdings into 15 equal holdings when I first buy them. So at the start of the year, the money's divided equally. It's not, I like this one more, so I'll put a bit more in it. No, they have to be liked equally because otherwise they don't deserve to be in your football team. Think of it like a football team as well. That's another way to look at it. Vladislav said, are you a guru? Well, I'm Indian, so you can call me a guru or a pundit, whichever you wish. They're both Indian words. Okay, so now we've got those, but that still has to appear in the other strategies. That's a good place to start to give us some names. Okay, the reason is we are not going to be speculating with the ones which are down here, right? Like American bloody Airlines. Those who are saying, oh, consumer cyclicals might come around, that's called gambling and speculating, and I don't want to do that. You can do that if you wish, and you might get lucky, and suddenly airline stocks go up one day, and then crash again. If you want that kind of sleepless night, go do it. But you can still get a good return without doing all that risk taking. What I'm saying is you can cross the road blindfolded, or you can cross the road looking both ways. I'd rather cross the road looking both ways. That or blindfolded both get you across the road, but one is far riskier than another. Okay, thank you, Vishnu. Investing strategy 2. Right? Remember, the more times a name appears in more of the strategies, the better the name is. Leverage big on low risk. What do I mean by this? There are certain stocks which are not very volatile, but tend to outperform the markets for a variety of reasons. Okay, they've got good profits. They've got monopolies. They can generate growing cash flow because they've got monopolies, and so on and so forth. With those, I 2 times leverage. What does 2 times leverage mean? It means if they got $1, I make $2. There's 2 ways in which I do this, and there are there's several stocks in which I do it. Okay, I do it with Microsoft because it's one of my quality picks. I do it with Amazon. They're 2 times leverage. It's called an exchange traded product. It's like a fund. Now, these have their own risk. Please be aware, anything leveraged is riskier than anything which isn't leveraged. So risk alert. If you're risk averse, don't do this. All right. I have 3 times leveraged in S&P index. It's an index, so I'm willing to go 3 times leveraged. And nothing else do I go 3 times leveraged. I only go 2 times leveraged. Okay. So what does that mean? Well, it means the S&P would give me a 30%. It's actually 100% return now this year. This is a bit out of date. This screenshot. All right. Amazon, if it goes up 1%, I make 2%, and so on and so forth. So why do I leverage in those? Well, I happen to know Amazon's and Microsoft's tend not to fall too much if they fall. I also do 2 times leverage in Apple. All right, Apple, Amazon, and Microsoft. I continue loving them. You might say, oh, you're too late into those. Fine, don't buy them. There's enough other ones I'm going to give you in a minute. I'm not going to argue the tops. I don't care whether you buy them or not. All right, but I'm just saying. And I'll do 2 times leverage in those. But that's just the starting point. It's not enough. You can't put all your money in those. So strategy 3 is I X-ray quality. What does that mean? I look at literally what other funds are quality based, such as the quality. It's actually that's the EPIC code for it. It's a fund. Okay, and it tends to do this since 2016. Tends to go up, goes down a little bit, goes up. So what the hell's in it? I X-ray quality. The tech time holdings are these. By the way, have your phone ready. Once somebody said to me, oh, you moved too quickly, I couldn't take a picture. Have your phone ready on photo if you wish. Okay, top 10 holdings by weight. It doesn't mean I'll just buy them. I then, narrow it down to which ones of those quality holdings are contributing the biggest returns. And out of these, by the way, oh, look, some names keep coming up. Microsoft came up again. Apple came up again. MasterCard came up again. I own all of those 3. Why not PepsiCo and Eli Lilly? Well, I can't own everything, and they probably didn't come up in enough of the strategies. So let's now move to strategy 4A. And this is one of my best ones, one of my favorites. I like this. Okay, investment strategy 4A. What banks are telling their richest clients? What are banks telling their richest clients? Okay, what are banks telling their richest clients? And this is what they're telling their richest clients. There's 2 ways you can find out. One way we find out, we look at, is what are the analyst price targets? Now, by analyst price target, I don't mean a stockbroker like a Hargreaves Lansdown or a journalist who I don't give a toss what a mediocre stockbroker thinks is a price target or what a magazine journalist thinks. All right? I don't care. When I talk about analysts, I'm talking about Goldman Sachs or JP Morgan. I'm going to show you those in a second. So back in April, okay, in April, there we go. I said, there you go, April, all right. I said, and those of you will remember have been on my webinar since then, that this could go from where it was at 42 up to, I said not 78, which was the target of the analysts, because I said analysts are always over optimistic. And I've written about that in my Financial Times columns. If you want the evidence and the research behind everything that I'm saying, it's in my FT columns. It's in the book that I'm going to give you a free download of. So when you read it, you go, oh my God, everything Alpesh said quickly in those webinars, it's all researched and academic research, and it's all in there, you know, in great detail. If you're, you know, a nerd like me, most of you, like my family members, won't want to read my book. They've never read any of my books. They just want the bottom line, which is what I'm going to give you. So why do I look at these from the big analysts? Well, because that's what I said. Well, today it's about $60. You can look it up. I don't know what the price bang on today is, but about a couple of days ago it was $60. That's a 50% return. So you can see since April, 50%. Yeah, guess what? It hits my 40% per annum. Capri Holdings had never bloody heard of the damn thing. But what I've noticed is that in April, when I did the webinar, the average price target amongst the analysts was $30. That was 134 34% upside. Now, listen to this really carefully. This is not from a journalist in a magazine. They often do this as well. Not from them. It is not from your stockbroker, who will often also write something similar, because they carry no bloody weight. And they're often rubbish and wrong. Rubbish and wrong. Rubbish and wrong, okay? This is from, and I'm going to show you which analysts I look at in a second. In April, I said it could go from $12, which is what it was at. There you go, $12 to 30. Why 30? Because that was the average price target of all the analysts. Today, it's at 42, so that's a 250% return. Okay? Okay? Capri Holdings is a multi-billion-dollar company. This is not some speculative AIM gold miner. Not interested in those. I'm not a gambler, right? In March, I said with Disney to my sister, some of you will remember this. I hope you do, because she does, when she wanted to know about school fees and what she should buy into. And I said, well, Disney. Okay, I said it could go from $99, which is what it was at, to 144, which is the analyst average price target. Okay, which would have been a 44% upside. In fact, today it's 173%. That's a 73% return. Yes, I am her favorite brother. Okay. In March, I said Uber Technologies, right? This was it in March. It was at $27, could go to $43, 55% upside, and it's now at $50. That's 85% return. Okay, 85% return. Okay. Vladislav, yes, that book by Ray Dalio, it's very good. Sadly, he lost his son this weekend. Billionaire hedge fund manager Ray Dalio sadly lost his son. The tragedy of having so much and losing everything as well. Anyway, it's a separate issue. But Vladislav, yes, it's a really good book from Ray Dalio. Viacom. Now, this is not just look at what happened. I'm going to give you the names which now fit this process. Okay, so I'm showing you the process works. I'm going to give you the names. Right. In March, I said it could go from 12 to 37. Why? Because it was at 12. This is March. Okay, and the average price target in the analyst was $37, 190% upside. Well, it's at $37. 190% return. Is that a self-fulfilling prophecy? Maybe, but its name turned up in others. Remember, it turned up in the Guru one, Strategy one. So it was in Strategy 1, Strategy 4A. Suddenly, it's ticking more boxes. Last one, United Healthcare. Never heard of it before until the start of this year. Then, all of a sudden, we've got a $323 upside, 33.4% up there. What happens? Goes from 242 to 323. Today, it's at 341. That's a 41% return. Okay, which of the analysts we look at? These. Now, I'll tell you what. The way we drill down is and what I'm going to give you as well. All right, Robert. It doesn't. Sadly, it doesn't. Anand asks, how does leverage stock work? Is it advisable for the newbie? No, leverage. It's considered is not advisable for the newbie unless you've become well versed with it and you've got risk capital. Because $10 down in the share price or something would mean you lose $20, you lose double. So leverage, control trillions in their influence. These are influencers. Yeah, like you get Instagram influencers. These are influencers in my industry. Credit Suisse, Morgan Stanley, Deutsche Bank, Goldman Sachs. You might not like them. You might think sometimes they're wrong. What's their position? How big a price target is it? And how recently was it made? So think of an algorithm. We weigh the algorithm based on the quality of the individual, the size of the bank, the size of the price target, the recency of the forecast. It was given 4 years ago. It doesn't matter, does it? Okay. It's done like that. If any of you lose the connection, just jiggle in. It's there's so many of you on this, so the connection could get lost. Okay. So that's 4A. What are the banks telling their clients? And I'm going to name some stocks in a second. Investing strategy 4B. What do big banks tell their clients? Still the same thing. Now, there's two things they tell them. I'm not going to look at the Altman score. I'm going to look at this. This is one other thing that big banks tell their clients. This has probably been the most important of all slides I've ever done, I would say. Okay, why? Well, because it's from Goldman Sachs and it's what they tell their richest clients. Let me just drill that home to you. Goldman Sachs Asset Management research team used this to determine what to tell their wealthiest clients. So what the hell does it say? You're interested, aren't you? You should be. Okay? They tell their clients that stocks which have a high CROCI, in other words, cash return on capital employed, which is basically cash flow, the ability to raise cash, higher the number, the better they perform. This is what their research found. What they found is total shareholder returns of companies in each sector relative Crookey quartile. In other words, the companies with the highest cash flow generated 30% share price return per annum. 30% CAGR means annual return. Okay. Alex, the answer is yes to your question. Yeah, if you lost sound, please reconnect. If you lost sound, reconnect. And just to recap for those who did lose sound, I think some of you just lost the connection there. This is taken from Goldman Sachs Asset Management. What they tell their wealthiest clients is to get 30% return per annum, pick the stocks with the highest Crookey, the highest cash return on capital invested. So I look at that and I say, right, which companies have the best cash flow? Okay, the highest post cash flow on capital. Now, why is that important, Alpesh? Well, just look at the economy right now. The companies which are going to fall the least and rebound the quickest are the ones with the best cash flow, the ability to generate the most cash from the capital they've already invested in their business. The ones that don't suck up capital, but can keep generating money. You know which companies have some of the worst cash flows? Airlines. Oh, retail. Oh, okay, Alpesh. Right. Okay. Can you see how I didn't make the mistakes so many people make? Not because I'm some kind of genius, no, because I just stood on the shoulders of what Goldman's are telling their bloody wealthiest clients. And this is why they charge them, well, they say to them, you've got to have 10 million just to open a private client account. Okay, I think it might be more actually, it might be 25 million now, but it was 10 million when it was 10 million in the past when I got this slide, okay, off them. Right, this is what they tell them. So this is why I want to look at that. Strategy for beat. Now, at this point, you might say, well, wait a minute, there's going to be a lot of stocks, aren't there? No, they've got to tick a lot of boxes. And this is why I only want 15 stocks. Because if you add more stocks, it does not reduce portfolio risk. It does not reduce. After about 15, it doesn't reduce portfolio risk more. You might say, no, Alpesh, I want 20. That's fine if it makes you feel better. Oh, no, Alpesh, I want 30. Okay, but you're making your life more complicated and you're going to more likely lose track. 15 stocks, 12 months. If they drop 25%, get out. So 12, 15, 25. 40 being what we're targeting. Okay, 12, 15, 25, 40. Those are the numbers I want you to remember. Nathania, sadly not. It's going to have to come from me on all my free channels, my free webinars and so on. I'm going to like on this. I'm going to mention them to you as well, the stocks as well. Investing strategy 5. Cash flow is king. I've told you before, it's probably one of the most important things. Warren Buffett always says it's important. And one way in which we value companies, I did this again back in March. I said this one, Alamask, can go from 63 pence, which is what it was at, okay, to £1.61, which would have been a fair value. Today it's at £1.10, so it's not quite reached there. That's an 85% return. That's a different manner, but that's not analyst, that's cash flow. Yes, there's many ways to skin a cat. There's not one secret strategy, and none of these strategies are secret. But what's secret is the way in which I do it. The way in which I do it, is I filter until it jumps all the hurdles. I make it jump a lot of hoops. Brilliant question from Jay. How do you judge stock diversification? 15 stocks, right? You might say, Alpesh, but what if all my stocks are technology? So let's say you're a technology stock. So we looked at the correlation of Apple and Microsoft, both technology companies. Guess what? They're not highly correlated. But Alpesh, how can they not be? When the markets fall, Costco and Microsoft are correlated. They both drop in tandem. Yet Costco and Microsoft are two totally different companies. Yes. So this whole idea of, oh, buy different sectors because you'll be diversified. I'm afraid it's brokers who haven't read the research. They haven't read the research on correlation. Correlation in the same sector can often give you more diversification than in completely separate sectors. And when the markets fall, everything is correlated. I'll say that again. When the markets fall, correlation increases. So 15 stocks, oops, I've got hair on my face, 15 stocks. Okay, 15 stocks. Oh, a lot of people having problems reconnecting. Try and refresh the screen. Sorry, it's just that there's loads going on. I'll tell you what I'll do. Let me just turn off. I'm going to turn off one or two other things. Pause syncing. Sorry about this. I know a lot of you are trying to, it's just that there's a whole load of people who are getting on the, and obviously I'm doing video. I tell you what, I'll turn off my own face. That should help as well. Okay, that should help. and I'm going to turn off some of the background services that I've got going on here. I'm going to pause syncing for 2 hours as well on some of the various things. So that should help with increased bandwidth as yours. Right now, so this idea of diversification, you've always been taught, oh, buy some real estate as well as a bit of retail. You know what it ends up having you do? It ends up you buying a load of rubbish companies. What matters more than any of those things is the company generating cash flow? When Goldman Sachs did this, right, it didn't matter. It didn't actually matter what sectors they were in. So for you guys, it matters. Sectors matter for hedge funds like mine because we're dealing with more capital. Okay, but it doesn't matter for the average private investor because even Apple and Amazon are diversified. Even though they're technology companies, even Apple and Microsoft, if you look at their correlations, they're not that great, I'm afraid. Okay. Thank you, my friend, Alex. Thank you, Alex. Thank you, Alex. I will put my face back on it. Just let the signal come back. So investment strategy 6. I missed 5. Don't worry about that. 6. Coattails of smart big money. What's smart big money? Well, it's not just going to be me. What's strategy 6? And remember, I want more stocks to turn up in more of my strategies. So, and the reason I'm teaching you all of this is so you move away from your reliance of fund managers, you move away from your reliance of journalists, and you move away from your reliance of news and noise. Instead, you have a very simple strategy and you understand what is quality and what isn't, right? So I ride the coattails of the big aggregate hedge funds. Hedge funds are the best in the world at what they do. Not always making money, but they're a lot better than long-only fund managers. Okay, so people like Neil Woodford would never make it as a hedge fund manager, all right? If he applied to my hedge fund, I'd tell him to get lost. He'd be too rubbish, okay? Long-only fund managers, they're rubbish compared to hedge funds like us. They might say, oh, you're a bit full of yourself, aren't you? Well, I'm sorry, but that's the case, you know. Ray Dalio is a hedge fund manager. Jim Simons is. Okay, look at Jim Simons' performance. These are people you won't even have heard of. They're bloody good at making money. So we look at all their aggregate data, okay, because they're bigger than I am. They're all bigger than me. I'm the guy they'd kick sand in the face of if we were on a beach, okay? So I looked at AbbVie, for instance. Strategy, like I said, strategy 6, where's the big hedge fund money going? And we saw, and this is the job of my team. Their job is to get me this stuff in front of my desk, okay? These are all the ones that we monitor and look at. You don't need to take a picture of that. These aren't stocks. These are hedge funds. We take their aggregate data and we look at which names keep coming up, keep coming up, keep coming up. My favorite strategy of late, and I like this one the most, okay, is this, and which names come up. And I'm going to name some names and what I own at the moment, okay? Vishnu's asked, do I invest in overvalued stocks? No, I invest in undervalued companies which are growing fast. Because if I invest in overvalued, I'm risking that they won't go up. Okay, whereas if they're undervalued and they're growing and they're generating dividends and gaining momentum, I've got an increased likelihood they're going to continue going up. Right now, you might say to me, Alpesh, no. I found this really rubbish airline and I speculatively put money in it and it doubled. Yeah, good luck to you. That's like going to a casino and you hit red once. Doesn't mean it's a bloody strategy. It means it's luck, my friend. It's luck. We don't want to do luck. So investing strategy number 8, leverage on statistics. And this, I love this. Now, I love this because I'm a geek. Okay, I'm going to explain it to you. This is the stock performance of a particular stock. And I only do this with about 4 different stocks. Okay, this is the one-day performance. On average, on any one day, most of the time, it generates a 0% return. Over any 5-day period, it generates about a plus 1%. Sometimes it could be down minus 16. Sometimes over 5 days, it could be up 19%. Over 20 days, it's generally up about 1 or 2%, as much as 29%, or down 29%. So you don't want to hold it over 20 days. I want to hold it over, like I said, 1 year, 250 days. 1 year, 250 days, okay? 250 days, right? Over 250 days, this particular stock, on average, generates 46%. Historic performance is no guide to the future, so I'm wary of that. Okay, it could be as high as 80%, could be as little as 30%. What does this tell me? This tells me if ever it's down this much, I want to get in because I know that over the next 230 days, it's likely to rebound up. That's a mean reversion strategy, but don't worry about that. Don't worry about that. What I want to tell you is I want stocks which look like this. What's the characteristic of these stocks? I want stocks which don't have too wide a volatility from a very high average. I want them to have a high average, reward, high, okay, high average. Those of you who understand bell curves know what I'm talking about. And I want the standard distribution, those volatility, the risk of missing that average return to be within a narrow band, a relatively narrow band, and to be positive. Okay, I'm not going to go into technicalities, but bell curves, kurtosis, standard deviations, those of you who are into it, you understand. For now, you don't need to know that level of depth, okay? I'm going to give you the answers. When I find stocks like this, and I'll name you which stocks they are, I tend to do 2 times leverage for 12 months on CFDs on those stocks. Why? Because over 250 days, that should give me between 26% in a bad year, not guaranteed because past performance is no guide to the future, to 80% up, 160%, probably closer to 90% up. And those leverage performances that's not included. Howard's right, it's Microsoft. This happens with Microsoft. There's only a few companies which have this distribution. Now you might say, Alpesh, can't you tell us companies which just have really high average returns and consistently hit it every single year and never deviate from it? That company doesn't exist. Man hasn't invented it, or woman hasn't invented it. Microsoft, Costco, Dollar General, Apple and Amazon are a bit riskier than this, but Microsoft is probably the easiest one with this. Okay, why do I 2 times leverage and not more? I'm not going to go into the mathematics and bore you, but if you do more than 2 times leverage, you're going to absolutely, how can I put this in a very posh way, crap yourself. I'll tell you why. Because after 20 days, if you've done 2 times leverage and it's down, God forbid, and chances are it won't be, it's down 29% underlying, so you're down 60%, you're not going to be happy. You're going to panic. You're going to be scared. Oh, I won't, Alpesh, I won't. Well, it's your money, your account. Don't do more than 2 times leverage, and only do 2 times leverage if you are a sophisticated investor who's willing to take risk. Investment at risk, you could lose more than your original capital. All those risk warnings, they're true and real. Okay, this is more for the sophisticated investor. This is for the sophisticated investor. Okay, Harry said they charge £10. Harry, £10 to enter. You're going to have to enter and exit, so maybe you paid £20 in a year on a stock, £20 in commission. Come on, Harry. I can't get you cheaper than that. If you want cheaper than that, have a look at free trade. But you know, if they don't charge you a commission, you know what they're going to do? They're going to put it in the spread. You're going to end up paying at least 10 quid, mate. Do you announce the leverage to your broker? Well, CFDs, it's there. It's an, I mean, it tells you. So they'll offer it. There's some brokers which offer leverage, like IG does leverage, for instance. There are others that don't, like Hargreaves Lansdown or AJ Bell, Halifax, Barclays. They don't do leverage. Leverage ones are more like the CFD brokers. Remember, it's for 250 days. By the way, they hate clients who do this. You know why? Because they want you trading in and out. So they make loads of commissions. They hate you if you do this. Because for a start, you're not buying their funds. Secondly, so you're not trading. So you're not earning them commissions. They hate you. They absolutely hate you if you do this. Guess what? When brokers hate you, you know you're doing the right thing. All right, so that's strategy A. So how I do it, the reason I blurred this out is so it's because this one's out of date. That's why I don't want to show something out of date. Okay, so what I then end up doing is value, growth, income, cash flow, okay, performance, momentum. Sortino is a measure of what I just said. Average return is high. Deviation, volatility from it is low. So higher this number, the better, preferably above 1. Alpha means outperforming the market. It's all I do, and I look for greens, as many greens as possible. I'll name some more names in a second. Okay, Harry, the answer is yes. So what am I looking at? Again, all of the stocks I mentioned, 9,000 stocks in the US and the UK, global companies that I mentioned, they are all eligible for a SIP and an ISA. You can put them in your pension, earn money tax-free. If you don't know what a SIP and ISA is, Google it. All right? You monitor it infrequently. Watch it every month. If it's dropped 25% from the highest it's been since you bought, then get out. Hold for 12 months. Okay, one screen is all you need. One strategy, no. We're going to have it in as many of those strategies as possible. Like I said, ideally, 15 to 20. I've been using that. I've mentioned some of the stocks I already own. Okay, in case I've not been clear, I also happen to own PayPal. I happen to own MasterCard, Visa. I own TechTarget as well. So I've thrown a load of names at you. Now, those are just mine, okay? I don't want you to just copy mine. But I want you to understand what the process is. Okay, I developed all of this when I was at university, when I was at Oxford Red Carnation, lost exam. Okay, I perfected this. I've used it to win awards in the Financial Times. That's me on the front cover of the business section of the FT, Patel is top FTSE 100 forecaster. They then said to me, do you want to write books about this? Which I did in order to raise my profile, which then allowed me to become a big fat hedge fund manager. There you go. Big fat hedge fund manager, and I beat people like Woodford in back then who were rubbish, and they raised billions because, well, they did. The ideal, what people then say to me, well, we want more than this. Don't just throw us some names now and again. For those who want more, stay on the webinar. For those of you who want more, people say, we want to do this at our own pace. We want you to give us one-to-one tutorials on this because we don't want to read articles and videos and course material. We want convenience of being able to do it wherever we are. We want you as a regulated hedge fund manager to be our teacher. No hotel costs, no travel costs. We want somebody who's not connected to a broker, therefore not conflicted, who gets this Goldman Sachs information, who gives us ongoing support, who gives us lifetime updates, daily updates, alerts of what he's doing, newsletters, tips, and no subscriptions. We don't want somebody who gives us software, free software, but not charging us daily, weekly, monthly subscriptions. So I tell people on my regular webinars, what I'm doing, what I'm buying, and then I also tell them, well, they've been saying to me, well, why didn't you do it? And we said, well, how do we make this into $1 billion business? So we spun out of our hedge fund, we spun out some a way of doing this by offering this to more people. And what we want to do is float that on the stock market. That's our plans for the future. Okay, as a hedge fund manager, there's nobody else to compete with us. Professionally trained community guy, was a barrister and a presenter at Bloomberg TV whilst I ran my fund at the same time. Okay, so Bloomberg paid me, Financial Times paid me for my articles. I'm a visiting fellow at Oxford University in Business and Industry at Corpus Christi College, where I lecture on behavioral finance. So you've got that as well. That academic research community, and as you've seen, FT award winner. I don't mean awards from some no-name entity. So we thought to ourselves, well, how can we make this something which could be part of a bigger technology business, something which the private investors want, something which disrupts the fund management industry so people don't just go to funds. How can we make sure people are empowered themselves to do it? So they go away from the fund management industry, they and disrupt that. That's $1 trillion business, because surely if you can disrupt $1 trillion business, you've got $1 billion business as well. Okay, so and it's the same stuff I use when I'm on the BBC, when I'm on CNBC, when I'm on all of those. And we made it available. Then what I did is I thought, well, wait a minute. We've got WhatsApp to talk to people. We've got Instagram to talk to people. We've got great reviews from hedge fund managers like Centaurus, from American Express, from Merrill Lynch, saying, Alpesh, yeah, you the man. Let me put it that way. Okay, BBC, Philip Hampshire, Coots Wealth Management, right? Financial Times. Great comments. I thought, wait a minute, these aren't just reviews from members of the public. These are industry people who've got reputations on the line. Okay, I thought we've got to spin this out into $1 billion business. We can have Zoom calls one-to-one with people, have Skype calls one-to-one and teach them all of this. So if they want to take it further than just get this, or give them access to my portfolio as well, then we spin it out, we float it on the stock market as a separate entity, we give them access to software, but no subscription charge, no daily charges, weekly charges. Telegram, so they've got instant messages from me. They can see scoring and rating across 9,000 equities, daily roundups, newsletter from me, all of this. But most importantly, this is what people love, the one-to-one calls to go over their portfolio and say to them, look, based on the education and research out there, this is wrong, wrong, wrong. This is a low rating. This is low. This is what quality looks like. This is where it should be. And so we created this in order to be able to do that, and then use all of the data and information I get, so they've got that personal contact with somebody able to say to them, this is why your SIP's underperforming, this is why your pension's underperforming, based on the education, based on the research we provide. If you want to be part of it, hold on, I'll give you a link so you can be part of it. We've had great reviews of people who've used me and my services, and what I do within that, because I think we've got something which can be $1 billion company on the stock market, because it disrupts that fund management industry. We give people software free so they can do it. They get access to free software, free mentoring from me, one-to-one, okay, alerts, tips for life, right? Because they've got all of that and there's nobody else doing it, we can evaluate their portfolio, we can suggest what the goals are, get the holdings right. They're managing it themselves, right? Nobody else does that. Everybody else wants you to give them the capital, so they manage it for you and charge you fees. We show them they can do it themselves and save those fees straight away. So some of them are saving 30 grand, 50 grand, 100 grand in fees each year. They get the updates, they get the information, they get the one-to-one for life, and the webinars and the events with me as well. My most successful student, Naomi Jomi, straight out of university, was my assistant for 3 years. She now works at Newton, where she manages 10 billion of assets under management. Okay, like I said, Zoom, Skype made it that more personal with people, and now people are used to it. I limit people coming onto the program to 10 at a time. For those who want more than what I've given them on the webinar, want that personal one-to-one sort of platinum touch to it all, I limit it to 10 because it's me doing the mentoring, okay? Of course, I've got my team helping me, but it's me doing it one-to-one. It's them who will analyze everything, get access to my spreadsheets, my database, and those one-to-one calls, go through their portfolio with them, okay? And I give them 10%, I give them 50% off, not even 10, 50% off for those who've been on the webinars, okay? Who are on this webinar and stay to the end, you get 50% off. You also get a signed copy of my most recent book, free. You get headphones, earphones, phone stand, so you can listen to the material, because there's course material which is updated daily, which goes with it as well. There's a direct Instagram straight from my phone into what I'm seeing as well. Yeah, Alex, I shared them throughout the webinar. I'll go through it again at the end as well. I'll share more names with you again. I'll review it all again. Thank you very much, Ravi. I better post that. Broadcast comment to room. There you go. Thank you, Ravi. You've been a fantastic student. The idea with this is, look, it's yours for life. We think it's a business model, which is fantastic because it's not subscription based. So you get to keep your money. I mean, the whole point of it is that you're not paying fund managers, you're not paying brokers, you're not losing the money that through those people. Again, in the first 7 days, you have your first call with me. We go through your portfolio, take you through the key education. The education, by the way, includes all of this material, down here. There is a broken down course in it, which you go bit by bit, but you don't have to do that if you don't want. You can just have the course with me. Some people don't go through the course material, they just have one-to-one calls with me, and I do the tutorial with them. We go through my spreadsheet of 9,000 with the spreadsheet with them as well. You can see the strategies there. So that explains why I'm giving the names I am, and what I've explained on this webinar. So you've got that, and I'll go through the names again in a second as well. Yeah, I'll give those names again, Jay. Alex, I'll give you those names yet again. I did it in the webinar. I'm sure you were paying attention, but I'll do it again. I'll give you those names yet again that I've just given through the webinar as well, okay, that I particularly happen to like. Now, and it gets you to a plan of action, right? And then a second call as well. We thought, how do we price something like this? And I thought, well, lifetime updates, you know, 10K. Because remember, it's not just about 12 months. You need to be doing this every year. And what about mid-year? What if a stock doubles up? You want to speak to me and say, right, I'll just doubled up. What kind of strategies are available? What does the education teach and so on? So you've got all that hand-holding. What if you get a new lump sum of capital coming in during the course of the year? What about year 2, year 3? So we thought we'd make it available for life without charging a fee. And these are not, this is not the charge. Okay, we thought, how do we add all this up? All this that we're giving to people, all this premium software, daily updates. So you can see why it's a billion-dollar business, because if you can get through this much value to people, and there's a global multi-trillion-dollar market, because we've got the American market, got the UK market, the French market, the German market. Hell, that's phenomenal. So in the end, we decided, and with the webinars, I knocked off even 50%. Then we reduced it to that, and that's the ambition of the company. You sign up there. It is first come, first serve, and it's only the first 10. It is only the first 10, I'm afraid. Use the coupon code ORG18. If you go directly to alpeshpatel.com/shares2, you don't even need the coupon code. The 7-day no risk money back guarantee. Even if you ask for your capital back, nobody's ever done that. But even if you did ask for your money back in 7 days, you still get to keep the book, the USB, the headphones, and everything else, okay, as well on that. And there's the coupon code, right? It's as simple as that. So Raj, I'll go through that again. It's shown to you earlier on in the earlier slide, so you might have missed it. If you came in a bit, did you come in a bit late, Raj? You might have missed it when I showed since 2004, how we've been hitting those targets. And remember, as a private investor, you can do what fund managers can't. Fund managers have to do European growth, UK growth, Japan growth, whatever they've been told to sell. So you've got the global market. That's why it's easier for us as private investors to make money than it is as fund managers. As fund managers, it's a lot harder. You've got you're handcuffed. You can't just have 15 stocks as a fund manager, because you've got to keep churning them and earning commissions and all the rest of it. That's why. So if any of you have problems signing up, let me know. Rita, yours has gone through, so has Reshma's has gone through. I've got a cousin called Rita, and she's got her second name. Well, her name's Reshma as well, so I don't think it's her because she'd just call me up. Let me know. Any of you have problems signing up on there? No, there is no ongoing charges. The whole point of it is you can access me as much as you want. I have no problems having one-to-one with people because I want to get a whole group of people who've been successful through this to then take to the venture capitalists, who will then 2 years later take it to the stock market. It's as simple as that. To get more people through it, I do the one-to-one training to show them, look, all these people like Ravi, they're making these returns. Okay, why don't you allow us to make a group of a few people? And why would I do that? It's one-to-one. Then what you're saying is, can you take on 20 people for £1 each? No, sorry, because I've got to put some limit on my time. You know, I've got people who are making, so I've got to put some limit. The webinar's free though, Alex. The webinar's free. Okay, can't give everything for free, my friend, right? I also want, so if you go to alpeshpatel.com/shares too, you can go there. You can pay in installments and access it immediately. It's 50% off. So you've got that. There's VAT, I'm afraid, if you're in the UK or EU. Okay, you can use PayPal if you wish. You can use cards, whatever. And like I said, you've got installments as well if you wish. But it is yours for life. It is yours for life, my life. Well, we're going to make sure it's in place that even if I'm gone, you'll always get access to the various pieces of information and data, including my databases and all the education material. The education material updated daily. There's a Telegram channel as well, a private channel, a private members channel. You can see there, on which I will post some of the more detailed information that I get from the other entities. And I've been taking people on in groups of 10 slowly and steadily since April when we launched this, and you can see some other names that I hold. Okay, so some of you, oops, oh wait a minute, sorry, wrong screen. You can't see it on that screen. I'll move the screen across. So no, I won't move the screen across. I'm trying to move the screen across. I can't move the screen across. Doesn't matter. I will do that in a second. Close window, open it again. It's stuck. Okay. Oh, wait a minute. No, that won't do it. Anyway, I'll give you the names again in a second of those individual stocks. Any of you having problems? Brian, if you're having a problem, just try the other side, because shares or shares too, whichever one you weren't trying, because if there's a lot of people trying to get through, that then often does happen. Let me go through, or you can just use this. A lot of people with cards have a problem, so you can just do a wire transfer straight to the company. Like I said, you can get, we've had, by the way, Peter just became a peer today. He's Lord Peter Cruddas. There he goes. Alpesh insights to the markets and trading are must read for traders of all levels and beginners. There's something for everyone. Thank you very much, Lord Peter Cruddas. Okay. Now I'm going to go through some of the slides again. Right. Anybody who wants me to hold a space, let me know. I can only hold it until the morning, I'm afraid. I'm not going to hold it for longer than that, because in the past I've held it and other people have been queuing up. Okay. Akib. If you're a member of pipspredator, let me know, and I'll sort something out for you. Just let me know if you're already on pipspredator. Raj, Bally Gifford funds have produced high double-digit returns. Good luck to them. It won't last. Persistence in performance amongst long-only funds, as I've written in my FT article, has been produced in research, doesn't last. For long-only funds, persistent performance doesn't last, and for a very simple reason: their fees end up eating away. Fund managers then leave. Guess what? You don't have an advantage. You're not going to leave anywhere your money to somebody else to manage, and you're not going to charge yourself a fee. So those funds, guess what? Sadly, they don't persist in performance. Because they're not a single individual, and they charge themselves big fat fees, and they get complacent, they get rich. The longer a fund manager's been at it, the poorer their performance tends to be. For you, you are highly motivated not to, because you don't get paid for doing nothing. A fund manager gets paid either way, even if he produces bullshit returns. So persistence and performance, there's a lot of research being done into it. Why isn't there persistence? Okay. Alex, yeah, you can explain to me what you mean. That's not a problem. We've got account, as it were, in dollar denominated account. So yes, it can be in US dollars, not an issue. Let me know and I'll send you a link. Do you ever recommend going short? On trading, yes, but this is investing. If you don't mind, CFD brokers. Oh, sorry, Harry said, what are my preferred CFD brokers? Actually, most of the ones you've heard of. So IG is fine. You name me some names and I'll tell you. So yeah, IG is perfectly fine. What other ones are there? ETX is fine as a CFD broker. Basically, FCA regulated ones are it's fine. Yeah, Alex, that's not a problem. Not a problem. I should say I have a lot of people who are non-UK based and are UK based. Both the things are fine. That's perfectly okay. Not an issue. On that, we can send you a link. On that, not an issue. Well, so we've got Toby. It's gone through. Yes. Thank you. As well, I'm going to go back through some of the names, some of the slides. So what I tend to do in closing is put some of the slides. Oops, sorry. Let me do that for you now so we don't miss it. Bam. There you go, arsenal.com. So, and I'll go through the names all over again. Okay, so some people who've missed it, it's this way. Right, so let me go backwards. All right, let me go backwards for you. Right, any questions you've got on the whole thing and the plan and what I'm planning with the company, let me know. Okay, as well. The reason I do this, one of the reasons is it's my product. When Bill Gates goes on. When he goes, well, not Bill Gates, Steve Jobs goes on air, it's him when he launches a new product because it's his baby. This is my baby, just like the iPod was his baby. This is my baby. Okay, so let me just go through some of the names and some of the strategies to give you a bit of a recap again. Okay, so somebody who missed it, 2 times leverage CFD. What were the names? Microsoft, Costco works with this. Dollar General works with this. It's got a similar profile. Okay. That was investing strategy 8. These were some of the hedge funds we look at. AbbVie, I own. Okay, AbbVie, there, another name, right? That people were asking because they missed the name. Okay, the link for the ebook. Oh, to download the free ebook, really simple. alpeshpatel.com. On there, under a picture of the Duchess of Cambridge, it'll say free book. Click link, click it. Okay. It's there. It's a bit of an IQ test. alpeshpatel.com. If you can't manage it and can't remember alpeshpatel.com, then you shouldn't be investing. So that's why we did it that way. You go to alpeshpatel.com. If you can't find it and it says free book and there's a button, then don't invest. It's just a way of, we've worked out how do we find people who shouldn't be investing at all. It's ones who can't find alpeshpatel.com on the internet. It's on there. Right. So AbbVie. Right. Alamas was the cash flow strategy. It's not in our portfolio now, I should say. That was the cash flow one. So let me name you some of the ones which using Croaky and so on. Okay. Which ones? United Healthcare. In case you missed one of my ones that I like. United Healthcare. Okay. Still one of mine. Viacom, still one of mine. Uber isn't. Disney, still one. Microsoft, I've already said. Apple, I've said. Facebook, I've said. Alphabet, okay, as well, is in there. Capri isn't, but this was just to show you what had been done. Citigroup isn't anymore, but to show you what had been done. MasterCard is in there. Visa is still in there, okay, as well, just so you've got it, right? Just in case you were missing some of the names from earlier and thinking, where were those names, Alpesh? Where were those names? Oh, Merck is in there. You can see it at the bottom of the screen, is one of mine, okay, as well, is one of mine. So just going backwards again through things, okay. I've still got, for the leverage part, 3 times leverage S&P 500. I've got 2 times leverage Microsoft and Amazon, okay, just to be absolutely clear what I own. Out of these, here, okay, I've given you a whole bunch of names. Now, there are some which I could have had, but I can't buy everything, so there's a whole bunch that I won't necessarily have, okay. Oh, let's just see if there's any out of these. Yeah, well, Apple I already mentioned. Out of these and Gates, what have I got? And Warren Buffett, feel free to take a picture of what he's got as well. It's not just all about me, okay. But they had to be in multiple strategies for me to have them. So Amazon, Microsoft already mentioned, MasterCard, Visa. Okay, if you wanted my names, T. Rowe Price, another one of mine. Okay, so you've got it out there. Snowflake, I feel I've got in a little bit too late. I don't have enough data on it, but a lot of people are getting in. Okay, T. Rowe Price, right? That's hit my, ticked my boxes, as it were. All right, so that's giving you a load of names. Shall I give you some more? And I've told you when to sell. Shall I give you some more? Do you want some more? Do you want some more? Let me just see. Did I mention some more names in this? Okay, yes. Globant, I've still got. Globant, I've still got. It's one of mine. I'm not sure why I'm not. I can't. The kid. Apologies, I missed some of this great webinar. Are you providing stock ideas or coaching? Both. Okay, both. Oh, that was the important thing. Somebody, was it Raj who asked? So this has been independently verified by independent third-party software company, and they've been doing it since 2004. They've been in real time, not historically, real time. So in January 2004, when I was 34 or whatever, they did the January picks. When I was 35, they did that, okay? And up to 2016 is where they were. Since 2016 to now, I've got to update this slide. It's gone even higher, okay? So that's them. And my point with this was it doesn't always go up. I mean, there are years when, like I said, financial crisis, I couldn't do anything. I couldn't produce some bloody miracle, okay? But on the whole, that's what we're looking for, okay? So both was the answer. Raj, Akib, thanks. Not sure about you. Not sure about you. I'm not registered. I'll do it now. I'm going to get as well. Yeah, absolutely, Akib. No worries at all. Are you on holiday until now? No, Jay, I'm not on holiday until Jan. I'm not on holiday at all. I love what I do. At 2 a.m., my students on Telegram are going to get messages of stuff that I've come across, which Goldman Sachs have just done. I'll be watching the market. I love this stuff. Okay, absolutely love it. So I do spend time with my family, but when they're asleep, I do this stuff. I love it. So I don't do holidays unless I do holidays, and even on holidays I do this stuff. So I showed you those. Oh, that was my first column. By the way, what I want to show you on this, just so you know, when we talk about track record. So the FT and my Diary of an Internet Trader asked me each week, we want you to, for 5 years, write down what you're investing in. And there you go. That was the very first column I'd done on September the 11th, 1999. I've been shifting virtually all my long-term holdings from UK into US stocks. So in case you want to know, okay, was this guy just made it up this year? No. Since 1999, I've been saying this, and then I've listed it in the FT, so it's all public as well there. But I, monitor it even more so through that company. It's monitored, and of course I post it on Telegram, so you get to see it. As my students, you get to see it, and you can look at it during the course of the year, and you can speak to people like Robbie as well. Thank you very much, Robert. I really appreciate it. I hope I've answered everything. Akib, does that mean you want me to reserve your place? Let me know, because I think we've only got one place or two places left. So do I have to use the same code? No, Akib, I'll give you a separate link for pips. It's a separate link. Once you sign up for this, let me know, and I'll give you the separate link for pips. Okay? Thanks. How often do we have these one-to-one sessions with you? For how long? I heard it's a one-off cost. As often as you need, Raj. Let me be absolutely clear. You can have the one-to-one with me as often as you need. You know why you won't need it very often? And you can have it as often as you need. And what we found, the reason I give it and say to people it's as often as you need is because, like a tutor at university who says, as long as it takes, because I know I can educate you and teach you. So you don't need it that often. But if you wanted it, I've got some people who've had it 5 times in the last 6 months since we launched all of this. I've had others who've had it once in 5 months. It's entirely up to them, okay? Because it's theirs for life. And yes, it is a one-off cost. I know, it's mind-boggling. It is amazing. It is incredible. You might say you're being stupid, Alpesh. No, if you want to create something which is a billion-dollar business, like the iPhone is a billion-dollar business, you know what? You offer it to people where it's a no-brainer decision. An iPhone has cost millions in development, but you still own one. You didn't pay millions for it. Why? Because it's spread amongst a lot of people. It's the same thing with this. The stuff that I'm teaching you is spread amongst a lot of people. That's why it's available like that, and that's why it's pretty bloody amazing. And it is amazing. And the other reason is, the more of you who make money from it, then the more people I've got who I'm able to turn around and say, right, venture capitalists, put 30 million into the company. By the way, that's the figure we're raising capital for. It's 30 million from venture capitalists. And because I get access to this information anyway, I get all of this. Okay, so when my team put it up on Telegram, right? Guess what? It's great. The tutorials one-to-one are always with me. You don't have to do the coursework, by the way. You don't have to do all of this if you don't want. The reason all of this is up there in the course material, it's updated daily, is for those who want to go to the nth level. Is there any? Yeah, Akib, sorry, the message is just sign up on the link which is up there. Okay, so I've held one for you, Akib, and I'll give you, and of course, there'll be the same discount on pipspredator as well. There you go, sign up there. That's the link you use to sign up, Akib. I think that's what you're asking. Narendra, only had it once. I'm now waiting for your IPO. Fantastic, fantastic, fantastic. Yeah, Narendra, you can have it more often. Just book it. Book it. You've got the links. If you haven't, email me. And that's why I do these webinars. So my students get everything as well. Theo, great ideas to hone my investment techniques for over 3 years. So have a lovely Christmas. Thank you, Theo, my friend, as well. Akib, there you go. There's the link. Sign up on that, and I'll make sure you've got the discount on both. Okay, thanks, Raj. Yep, I've done that. Robert, thank you. Jay, thank you very much. Who am I missing? Are there any questions I've missed at all? Kid. Alpesh, do we aim to get out of 40% average across the portfolio or get out of individual stocks? Nah, very good question. No. So if you've got 15 stocks and you don't, as soon as any stock goes up 40%, you don't get out of it. Because what if it goes up 100% and another one's gone up nothing? Well, they've averaged each other out. That's why we have 15. Because if I knew every stock was only going to go up 40%, I'd only buy one stock, wouldn't I? So even I can't predict that level. That's why what I say is no. The exit rule isn't 40%. The exit rule is 12 months, or if it drops 25% from the highest it's been. So if it's been up, say 200%, and it drops 25% from that, then you get out. Do you see what I'm saying? Have I missed any slides in this? I like to review the slides at the end. One more course from Microsoft. By the way, just so you know, full disclosure, what do I own at the moment? I don't own Tesla. Too volatile for me. You might say, you idiot, Alpesh, but that gives you an idea of what I do and don't do. Okay? Because if I got Tesla, I'd have to get 15 other different companies, which are shot up. Sorry. Okay, so what do I own? Microsoft. I do own Adobe. Okay? Microsoft, Apple, I still have. No issues with that. Visa, MasterCard, as I've mentioned. So I've given you more than 10 names of what's in my portfolio at the moment anyway. My job, okay, not sure. Oh, no, we've done all that. Thanks again. Thank you, Kid. I am quite there to be in. Fantastic. Excellent. What passion. You're on a real high tonight. So nice to see someone enjoy. Oh, I love this stuff. I don't know why I love the market. Do you know what? If I didn't love it, and that's the thing, I couldn't have written the 18 blooming books. I couldn't have got the Financial Times column. I couldn't have got the Bloomberg TV show. Only when you absolutely love it. You see that guy on TV, money saving expert, Martin Lewis? It's a bit like that for this. Ravi, Dimpy, and I do enjoy watching these. The best investment made in 2020 was in Pips in your investment program. Just looking at 21 portfolio, I'm sure Dimpy will come. Oh, yeah, ask Dimpy. Dimpy's not only a friend, but she's part of the team. Yes, Ravi, please. Oh, what a lovely thing for you to say. Please do. She's an apprentice of mine. Please have her get in touch with me. And that's the thing I said about my apprentices. Don't be shy. You paid for it. Please get in touch. Any questions you've got. Okay, we'll go through and send me what you've got. Any questions? Because we go through your portfolio with you. I do a one-to-one Zoom with you when I say to you, and we evaluate it and we show you the education. PBRA, Petrobras. I don't have Petrobras at the moment. It's up 16% there. That one or that. They're pretty much of a muchness. Okay, so don't worry about that. But you do remember, I don't know if you remember, Jay, Petrobras was one of the ones which I'd shown earlier. I noticed a lot of the stocks you own are owned by hedge funds. Funds such as, I don't know that fund, so I'm not going to mention its name. I don't know it, who they are. They may well. If you have the stocks that I have, remember what one of the strategies was. Which are the biggest funds going into? What are Goldman Sachs saying? And that keeps delivering results. So you would expect the ones I own to be owned by other people. Otherwise, I don't know how to answer that question. If the question is, why are things you own owned by others? That's part of the strategy. Okay, so anyway, I'll leave you guys with all of that. I think I've gone through everything that I possibly can. So Guru buys, there you go. These are some of the hedge fund ownership ones. It doesn't mean I just buy it because of that. It means it goes into. So I want it to be pre-owned, as it were. Okay, I want it to be pre-owned. And I should say, obviously our hedge fund owns some of these as well. That's a separate issue. Trust me, you buying Microsoft is not going to make my performance better. You're not going to move the stock market price on that. Yes, Akib, not a bother at all. The link is at the top of the page, alpeshpatel.com/shares2. And the link is here as well in the comment, alpeshpatel.com/shares2. And that's got the discount in it, and I'll make sure I'll send you a separate one for pips, and that's already included as well. I'll make sure I do the same for both, so don't worry. So there it is, Akib, for both. Any questions I've left? You'll notice a lot of the ones I mentioned are not owned and are not held by these guys, and that's just because they might have different reasons for owning this. They might have different risk profiles. They might have owned them from a different time and whatever else. I mean, some are, look, I've got Alphabet, so is Leon Cooperman. I've got Apple, so is Warren Buffett. But I don't have Coca-Cola. He's had it since 1963. I have American Express, actually. I don't think I mentioned that earlier. I'd better disclose that. I've got American Express, so is he. Okay. Oh, that's not rocket science, Alpesh. No, it's not rocket science. It's not rocket science. Tech Target. If you want names that you've not heard of, Tech Target, multi-billion-dollar company that I own as well. Oh, Alex, here's the link. You might be the last one through the door, Alex, if you sign in now. Here it is. Here it is. Here's the link. Please use it tonight and use it now, my friend. alpeshpatel.com/shares2. Any problems, let me know. I've just sent you the link, Alex. Anybody else who want the link to sign up tonight, please let me know, because once it's gone, it's gone. And then mañana, or whatever Mexican is for it's gone. Mañana's tomorrow. Okay. So anyway, I'm just going through the slides in case you missed any of this stuff, in case you missed any of it. All right, it's there, and the strategies that we use and how we get down to it, and why with your portfolio we simplify it. Remember these numbers. If you remember nothing else, 12 months. Goldman Sachs also shows 12 months is a good holding period. 1 day is too short, 5 years is too long. 12 months, then we review. 15 stocks. If they drop 25% from the high since you bought them, you exit. Okay, 12, 15, 25, 40% is what we're targeting. And like I said, we filter. The reason for showing, I didn't show you Altman scores earlier. The Altman score is just the higher this number is, the better. You don't need to worry about it. It's another thing used by the big banks as well. Alex, oh, I see what you mean. Yes, I'll make a note of that, Alex. I'll see how to actually that. I'll look into that. I understand. No. I've got. We have a similar thing with some of our hedge fund clients because it's about remittance. That's what we're talking about. Please remember that I'd like to be able to use the discount if I stay on. Yeah, of course. I'll send you the link and I'll hold it for you, Raj, as well. Okay, there's your special link, Raj. Shares 2. Okay, there you go. Shares 2. It's over there. No, I understand, Alex. I know it's about remittance and so on and so forth. Completely get it. So we'll look at that and work out a way on that one. Okay. Oops. I'll remove that one. Any other questions? Anything that I've missed, let me know. Anything I've missed. Like I said, this one was just great. And you know what? I didn't invent this. I didn't create it. It's not my secret formula. It was actually created by Deutsche Bank and now used by Goldman Sachs. So both Deutsche Bank Wealth Management and Goldman Sachs Wealth Management use it. That's the whole point. That's the whole point, that they both use it. Okay, can you believe it? So my whole point with everything that I'm saying to you is it's nothing that I've invented. The only difference is the process. Just like I don't know, Elon Musk didn't invent rockets or rocket fuel, but he did invent a process which changed things. My process is filter, using what works. And the academic research actually came about from when I started writing my Financial Times columns. Because when I'm writing the FT columns on what I'm investing in, I had to do a lot of research to write those columns. And as I researched what the universities were spewing out, I realized these university research suggests that certain things are better than others. Oh, I'm reading Goldman Sachs. This suggests that this works. So then I thought, well, if this works and this works and this is, what if I filter until all I'm left with is valuation, undervalued companies, high growth, income, cash flow, which is this part that you're seeing now, dividends. What if I filtered across all of those? Last question, can I start a portfolio now or wait until 2020? Oh, entirely up to you. Entirely up to you. I've got some people who say, now's a nice quiet period, Alpesh, and I've got some calls scheduled with my students between now and the new year. And they say, it's a good time, I'm going to start it, but I'm going to pull the trigger in January. My brother-in-law said, actually, two of my brothers-in-law, I spoke to both of them today by coincidence. They both called me, which is a bit odd. And they said they both want to start it on January the 2nd. And I guess because, I don't know. Anyway, but that's perfectly fine. There's no issues. Because remember, if we're looking at a 12-month holding, a few days here or there, don't sweat it. I am not gambling that the stock market's going to rally in the next 3 days. We're going to miss the opportunity of a lifetime. None of that nonsense. So it's yours for life anyway. The whole program is yours for life, Jay. So given it's yours for life, I've got some people who say, I'm going to lock in the fee now. Oh, by the way, that's because the fees have increased and they continue increasing substantially. As I get more people signing up, the fees keep going up, supply and demand. So don't be surprised if next time this is not 50% off 20,000, but it's 50% off 40,000, I'm afraid. There's two reasons for that. One is supply and demand of my time. It becomes more precious the more people are on the program. And secondly, people are making lots of money. If they're making lots of money, it's only fair that they pay a fair one-off charge for that because they're getting it for life. So there's two reasons for it. I sometimes have families joining. By the way, if you're joining husband and wife, that's fine, but not husband and wife and 3 kids. I've had that, and we had to, say, hey guys, come on. Can't look at portfolios for husband's portfolio, wife's portfolio, child number 1, child number 2, child number 3. And we've had some people who wanted to do it, save, get everything right, learn. It's an education. Learn everything for their kids. Others who want to do it for their grandkids and so on. So it's when you put all that together, and we thought, you know what, this is really valuable and it's unique and it disrupts the fund management industry. What we're not trying to do is say to people, hey, let's put it into 3 types of index tracking funds, low risk, medium or high risk. It doesn't work. If you want to know index tracking doesn't work, look at the FTSE 100 since 1999 when I wrote that FT column and said I'm getting out of UK. It's at the same level as it was when I wrote that column in the Financial Times in 1999. How bloody right was I? 101% right I was. And this is what frustrates and annoys me, that people still haven't, including my own family for whom I've really done this webinar, followed the advice, because people they don't listen, and then they go, oh, my pension's not doing too well. Anyway, I've gone through these slides twice now, but you get the idea of what we do. And by the way, this is what we do with your portfolio. So if you've got a pre-existing portfolio that needs cleaning up, we put it through our filter system like this. I then have the call with you, and then I show you what's on mine out of 9,000. I give you access to 9,000 stocks. For every single one of them, we've done all of this. So you can see, and then we show you which ones I particularly like. So you're picking them yourselves, and you're learning why, and you're seeing why. But on the one-to-one calls, you're seeing why yours don't fit. Oh, they might. Some of them will, and which ones should. It's as simple as that. Okay. Okay, right, everyone. I really am going to go now. I think it's time I went. That's everything I think I can go through and give you on all of that, and hopefully you found it all useful. Again, any questions I've not answered, just let me know any part of it, and I will happily explain it. My overall ambition for the company, not that you care, is to get about 200 people through the program, and then go to venture capitalists, raise 30 million from venture capitalists, and then 2 years later, probably sell about 20% of the company for 30 million, and then 2 years after that, float it, preferably on the London Stock Exchange as a disruptor like no other. Everybody else out there is trying to either sell you funds or they're trying to push you into index trackers. Low risk, medium risk, high risk. And guess what? Those models do not work. And people are going to work out that they don't work because they're going to look at the index and they're going to say, how come in 21 years I've not got a bloody return? How come it's so hit and miss? Okay, it's as simple as that. How long does it take to go through 200 stocks? About 5 minutes. Because think about it. If I've got, let's say you've got 200 stocks, or let's say I've got 200 stocks, and I've done this with them, where's it gone? Won't even take 5 minutes. Let's say I put it like this, then we just filter by color. Okay, we want the ones which have got the highest and best value growth income rating, the highest cash flows, the highest alternatives, the highest alphas. And guess what? I can get down from 200 down to 15. Job done. Simple. 5 minutes. 5 minutes. But if you want to understand what the croaky is, and you want the one-to-one tutorial with me, hey, that might take 10 minutes for me to explain it to you. And yes, it's the same stuff that when I'm on the BBC and all the rest of it, just so you know, I'm a public figure. So this isn't stuff which is, oh, he's just come up with it. That's the same stuff when they're telling me to pick stocks on air. Okay, it's the same analysis I'm using on air. My reputation is at stake for the last 21 years to make sure I get it right. And so much at stake that I won the competition in the FT. Doesn't that focus your mind and get things right when you do that? Okay, so it's the same thing. Now, if you said to me, Alpesh, no, I want you to sit down and explain this to me. Well, I'd probably say all of this, it typically takes in the first call with a apprentice, a new apprentice, 1 hour. I always tell them the first call, please give it 1 hour for me to sit with you. Sometimes 90 minutes, but usually in about an hour, Raj. That's how long. Okay, it's as simple as that. I've got some students who've got 200 stocks. They've got 200, and my team in the background, they'll before our call, by the way, they will do this. We don't sit in that call, by the way, and go through each one of your 200 stocks and go, well, BT's like this and this like this. No. We've got the numbers for it. My team before your call with me will have got all of this ready for me, just like a surgeon going in for brain surgery. So then I can explain to you and say, listen, these stocks don't hit these criteria. Then I explain to you the criteria. That takes, 30 minutes to explain all the criteria. So do you see how the process is very efficient, both for you and me? So it's not painful. That's the whole point of it. Now, I better go. I think I've got to reply to a couple of you. Alex, I think Akib's on there. So I think I will reply to a couple of you, but the rest of you, it's fine. And yeah, I want to sort 2021 out for people. So a lot of people are worried about their future. My wife said, you know what? Fundamentally, there are things we can control and things we can't. We can't control the virus, but the things we can control are our finances and our education, and make sure that we are on top of those finances. Those things we can control. Those are the things that we will take care of. Okay, it's as simple as that, and that's what I'm doing with this. So thank you very much for everybody who's signed up and joined. I'm going to be speaking to you in a second on the other side. Thanks, everyone.